Welcome back to another What to Expect this week, especially before tomorrow, which is the Consumer Price Index inflation reading. It comes out at 5:30 a.m. Pacific time. I will be live streaming it. The very next day, we're going to get a PPI, and then the very next day after that, we're going to get a consumer sentiment survey, which is also very important because we need expectations to come down so that the Federal Reserve can actually cut. Now, when I say that, people are like, what do you mean the Fed's actually potentially going to cut? Yesterday, we dove deep into this on the channel. We talked about how the Federal Reserve wants real rates to be about 2%. Well, if, and that would be measured by what the rate is of the Federal Reserve, which is about 5% right now, minusing off the 1 year out inflation expectation, which is 3%, which creates a 2% real rate. That's the formula Jerome Powell gave us. Well, if expectations go down 1%, we can drop interest rates 1%. So it's a big deal. But guess what drives expectations? The actual inflation report. So you tend to get this self-fulfilling prophecy, where if you get this high CPI inflation report, all of a sudden people are like, dang it, prices keep going up, and then they expect prices to continue to go up, and they expect that there's going to be no resolution to the inflationary crisis. After all, there are still businesses raising prices, especially those with large PP. Pricing power. Like, for example, on Wednesday, because we're introducing basically a whole new course within a course for free for existing members, we're increasing the price to the AI course $120. It's a big deal. But fortunately, we don't show up in the CPI measure, so it doesn't so much matter. But what does matter is that on Wednesday, we're going to get the CPI data, and I'm going to go through the projections with you. We've got a few. We've got JP Morgan's expectations for what could happen, and then we've got expectations for these various surveys. So that's the most important one. I quickly want to get PPI out of the way, which is the producer price inflation. A lot of the numbers are going to be higher between CPI and PPI because energy costs were higher in April than they were in March. So the headline numbers are going to show an increase from the March report, and you're going to see kind of a spike up. But you'll want to look past the headline numbers and you'll want to look at core numbers because we've already seen energy prices basically settle back down. A lot of that had to do with OPEC production cuts and a lot of drama around that. So we'll see some weird headline numbers. Like, for example, with PPI, we're expecting 0.3 on the month over month, whereas before that we were at negative 0.5, which is remarkable. But if we go to core, stripping out energy, food, and trade, we're expecting to be at 0.3 on PPI. Still higher than the 0.1 on the prior report, though. So you're actually seeing potentially there's some stickiness in that core producer price reading if we end up matching that survey, which is not great. We really want these numbers to come in soft. Nothing about these price numbers tells us anything about the state of the economy, right? That's important to remember too. Like, we could have strong GDP and low inflation. So when we get low reads on CPI, there's nothing that says, oh, the economy is faltering because prices are coming in low. No, we want price increases to stabilize because everybody's worried, markets, bond market, everybody's worried about stagflation. Stagflation is when the economy slows down while at the same time prices are still rising. It's the worst case scenario. You want a booming economy with low and stable prices. That's what you want. Slight price increases, 1.5%, 2%, maybe 2.5% increases. Not runaway inflation, because that means the Fed has to crimp the economy more and potentially over tighten. That's the big fear of the stock market right now, which is why there's so much tenuousness in the market right before this report. Now, keep in mind that in order for us to maintain that sort of Nike swoosh recovery, we have to slowly Nike down swoosh in inflation. But if inflation reignites tomorrow, the Nike swoosh could be over. Now, before we continue, a quick note from the sponsor for this video, the FT Edit app. Huge shout out to the Financial Times and the award-winning journalists at the Financial Times who deliver via the FT Edit app 8 hand-picked, in-depth articles every weekday from world-class journalists to deep dive stories across the board and spectrum of topics. No distractions, just award-winning content at a lower price. You can now get 30 days as a free trial if you use my link down below. That's the FT Edit app. Just make sure you click the link in the description down below. Now, there are three amazing things that I really love about the app that I'll quickly tell you about. Number one, I think it's so easy to include in your routine on a daily basis because it organizes all the topics by day, which is so fantastic because when it organizes by day, if you happen to miss a day, you can go back and see what you missed the day before without scrambling through or trying to get to the latter pages in an old newspaper that's crusty or on a website where you may miss some important things that happened that day. The second thing I enjoy is it shows you story progress. So it tells you, did you get to the bottom of the article? And it picks up where you left off. So for example, on this story on Alvin Bragg, they talk about, hey, there's a lot of skepticism in the public right now because Alvin Bragg, in the case against Donald Trump, didn't include what that additional crime was in order to elevate this case in his indictment. Briefly talked about it in the press conference, but that would have been a good idea. So now if you actually get to the bottom of the story, it'll show complete with a check mark. Really good motivation. Number two, great high quality journalism by the Financial Times. And the third thing I love over here is not just the additions or the quality, but the saved segment. For example, I was reading this piece on why Americans are dying so young, and I was really surprised that I thought this was going to have to do with diet and maybe some kind of drinking or food, but no, it actually had to do with overdoses, gun violence, and dangerous driving. So more societal, youthful carelessness traits rather than diet. I was really surprised by that. And so it's little nuggets like that that honestly throughout my day, in my opinion, make me a lot more valuable to those around me. And shout out to the Financial Times because they've got a great product via the FT Edit app. Check out the link down below to get yourself 30 days totally for free. And after that, you get amazing quality journalism from the Financial Times directly to you via the FT Edit app. Link down below. Click on my trial for the Apple App Store and iPad. Terms and conditions apply. So this is a big deal. Now, I don't think it will be over, and we're going to look at these surveys. But anything that indicates okay, inflation isn't going away, is going to be a problem. So again, PPI, even when you look outside of the volatile segments, we're expecting a little bit of an acceleration from 0.1 to 0.3. And that's on Thursday morning at 5:30 a.m. We'll be covering that live on the channel, so come by. So that is potentially a red flag we'll want to pay attention to. Hopefully that comes in soft. We'll also on Friday morning have and this comes out at 7 a.m. Pacific time, we'll have the University of Michigan Consumer Expectations Report, where we are currently expecting the 1 year out inflation expectation based on that report to drop from 4.6 to 4.4%. The Fed's PCE inflation expectation report is sitting at 2.9% right now. We really want to see that University of Michigan one come back down. It used to be a lot lower. It ran up last month. That's not good. We do not want that to continue to run up. So hopefully that comes in low. So we want PPI to come in low. We want the expectations to come in low. But then, of course, we've got CPI. And so what are the expectations for the Consumer Price Index? And what are the potential scenarios based on various different prints of what the stock market could do based on JP Morgan's expectations? Well, let's analyze that. First, CPI month over month is expected to come in at 0.4%. That's way higher than the 0.1, but again, that's not core. Energy prices are going to drive that up. So what's core going to do? Well, core is expected to come in at 0.3%. That would be okay. I would be willing to completely accept a 0.3% because that's annualized 3.6%. It would show us a continuation of a trend down. Yes, I understand. It is higher than 2%, but don't worry. Being higher than 2% is okay. It's going to take time to get this number down, and that is okay. What you want to pay attention to is that the trend is coming down. So look, for example, on screen now. You're going to see this latest line, which is blue. And that blue line shows you the latest CPI month over month core reading for CPI. Again, the expectation this time is that we're going to get a 0.3 read. A 0.3 read would be right there where that red line is. So you can see currently we're slightly above that at 0.4. I'll circle 0.4 right here in the blue line. The pink line is the expectations line, sort of the average expectations line. So blue is where we are. And what you can see is that this number is very volatile. It goes up and then it goes down, it goes up, it goes down. It's pretty volatile, right? So what you really want is to see a smooth trend down. And you could say we approximately have that. It's taking longer than expected, but if we draw, for example, an orange line here, and just try to draw an average here, we could see that we're probably doing about this. That is, the blue lines are moving up and down around this, but we are clearly trending down. And a nice read at 0.3 on the month over month for CPI, which is the expectation, would be good. Now, lately, surveys have been pretty bad. That is, they're not very accurate. There's a lot of volatility, and that's normal. Around periods of economic stress, there tends to be a lot of volatility in the data, which is unfortunate because when you have volatility in the data, well, let's just say it makes these surveys less useful, and when the surveys are less useful, more people get jaded and doubt the outcome of these surveys at all, and then they wonder, why do we even look at these surveys? And I can't blame that because they have been wrong so many times in the past, but they're useful for evaluating what the market's expectations are. See, if the market expects one thing and we get something totally different, well, then we kind of know what the stock market's going to do, right? So that's important. Now, let's consider what and where those expectations sit right now, because they're somewhat useful to look at on a chart. And we'll look at the core CPI month over month expectations. That is right here. So on the right side, you could see this red bar chart, which shows you the most of the expectations for CPI month over month actually average 3.6%. That's the average read. However, the median read is 0.3%. So we kind of tilt closer to 0.4 on this chart, with more sitting over here at about 0.3. Now, this does mean that we're pretty open to a downside surprise, which I like. Because, boy, if we got a 0.2, oh my gosh, nobody is expecting a 0.2 on the core month over month. Nobody. Now, that could be a sign that it's just not going to happen, but that would be fantastic for stocks because nobody's expecting it. Whereas anything like a 0.3, 0.4, I'd say is relatively expected. And then, of course, we taper off over here on the bell curve to about that 0.5 direction. That would be terrible. That would be very bad if we got something in that direction. So we don't want to see that. The month over month chart itself looks something like this, a little bit more predicted at about 0.4. But again, the month over month non-core, in my opinion, doesn't so terribly much matter. What's going to matter a lot more is what happens with the sticky segments of inflation. And as you can see, most of our inflation right now is generated by this blue chart right here. This blue chart is your services, X food and energy segment. And we'll really want to pay attention to services X housing, especially since we think that either this month or next month, we could actually start seeing the second form of disinflation, which is housing disinflation. Let me remind you really quickly about the three forms. Number one is goods disinflation. That we already have. We already have goods disinflation. You had a lot of goods inflation here in the pandemic. See that orange? You can see how that orange has basically disappeared over here. So we have goods disinflation, or no inflation from goods. We are soon expecting housing disinflation, but we still have not yet seen the X housing services disinflation. That's going to be your haircuts, CPA, attorneys, and just other goods, other services like going to restaurants, air travel, and other associated expenditures with things you hire people to help you with, which could be dental care, medical care services, otherwise, right? These are really sensitive to labor costs. So as labor costs rise, you tend to see services inflation rise. And even though the labor market has softened, it's still pretty dang tight. Businesses are still hiring people, and companies still have job openings. And they're not solely for lower income jobs. You're still actually seeing some cybersecurity companies, technology companies hiring. It seems like they've just gone through sort of it's insensitive to say, but like a weeding, and those people are finding new jobs, and that's why the economy keeps sort of booming along and consumers keep spending, which seems wild. But anyway, we're looking for that services disinflation. If we can get X housing services coming down to around 0.3, that'd be great. We got to get away from the 0.4 and 0.5 because those annualize to 4.8 and 6% inflation, way too high. We need these next two CPI reports to come in juicy, because if they don't, the Fed's going to keep hiking. It's not going to be good. So a lot of this report is going to help us dictate what the Fed is going to do. Now, here's JP Morgan's view. JP Morgan views that they're judging this based on the headline estimate, by the way. I preferred they did this read based off of the core month over month. I don't think the headline matters that much. The headline is expected to be 5%. So if we got a report above 5.5%, they think the S&P 500 will drop 3%. They think there's about a 4% chance of that. They do think there's a 25% chance that we're going to get the headline between 5.3 and 5.5. And they think the S&P will lose about 0.75 to 1.25%, 25% chance of that. 50% chance of a slightly hot to at match, which would actually even slightly hot on the headline, they think will lead the S&P 500 to gain slightly. Seems like people are bearishly positioned then. And then, of course, you have getting a below, which could potentially add to the S&P 500, as you see here on screen. Getting something super low like this, basically not going to happen. 99% certainty that's not going to happen per JPM. But 20% chance of getting that 4.7 to 4.9. Again, this does include energy pricing, though, so I think that's relatively unlikely. The core is going to be much more important. And we're looking at this core month over here. The implication for core month over month is 0.4%. That is JP Morgan's view. The actual survey core is 0.3%. So JP Morgan's coming a little hot on that core, which wouldn't be great. So we'll see what happens. But now, why does this all matter? Well, again, it all matters because of the Federal Reserve. So write down these numbers, because these are the ones we're going to read off tomorrow morning. 0.4 headline month over month, year over year 5%, core year over year 5.5, core less food and energy 0.3. Those are the expectations. That'll be followed, of course, by PPI, the price increase for the courses on building your wealth, and the AI course for making more money with PPI tomorrow, and then U of M on Friday. All of this is going to bundle together and give us guidance on what the Federal Reserve is likely to do next. The Federal Reserve next meets on June 14th, which comes a day after the May CPI release on June 13th. That's really important because it means the Fed is going to look at these two next reports to determine, do we pause? Do we start talking about cutting? Or do we hike more? Right now, everything is coming down to these next two reports. So 50% on this next report, 50% on the next CPI report. Yes, of course, we're going to have other jobs data, PCE, PPI. But in my opinion, everything it comes down to those expectations. And the CPI reports get so much media attention. It's a high pressure on that CPI report tomorrow. So I'll see you there tomorrow morning, 5:30 a.m. Pacific time. Check out the programs on Building Your Wealth link down below. If you need a bundle code, email us at kevin@meetkevin.com, and we'll see you in the next one. Goodbye and good luck. Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced